Picture this. A young couple walks into a house that finally feels like theirs. Not rented, not temporary, the real thing. Sunlight coming through the windows, empty rooms full of plans they haven't even said out loud yet. It's not just a purchase, it's a milestone. Proof that they're moving forward. They sign the papers. 30 years. It sounds long, but everyone says the same thing. This is how it's done. Property goes up, time does the work. You just hold on. At first, everything feels normal. Payments go out each month, manageable, predictable. Life continues. Maybe the market even ticks up a little, just enough to reinforce the belief that they made the right move. Then, slowly, it turns. Prices dip. Nothing dramatic, just enough to notice. They brush it off. Markets fluctuate. That's normal. But then it tips again and again. Now it's not noise anymore. It's a trend. Homes around them start selling for less than what they paid. Not slightly less, meaningfully less. The kind of difference you can't ignore. If they sold now, they wouldn't just lose the house. They'd still owe money after it's gone. At the same time, work tightens. Raises don't come, hours get cut. Income shrinks, not suddenly, but enough to feel it. And through all of that, one thing doesn't move. The mortgage. Same number, same due date, every month. Unchanged. And this is where it hits. They didn't just buy a home. They locked themselves into a fixed obligation in a world where everything else is starting to fall.
Now, here's where the story gets deceptive, because deflation sounds harmless when you first hear it. In fact, to most people, it sounds almost positive. Prices go down, goods get cheaper, maybe housing becomes more affordable, maybe food, electronics, and basic necessities stop rising for a while. After years of hearing that inflation is the enemy, deflation can sound like relief. But that reaction misses the mechanism completely. Because an economy is not just a collection of prices. It's a web of prices, wages, profits, jobs, and debt obligations. And when deflation sets in, those pieces do not move together in a clean, balanced way. Some things fall quickly, some fall slowly, and some don't fall at all. That last category is the dangerous one. Your mortgage payment doesn't fall just because home prices do. Your business loan doesn't shrink because customers spend less. Your student debt doesn't politely adjust because salaries are weaker this year. The obligation stays fixed. The number on the contract remains exactly where it was the day you signed it. And this is the heart of the trap. In a deflationary environment, the asset you bought with debt starts losing value, but the debt itself doesn't. So the collateral declines while the burden remains. If your house falls 20% in value, you are poorer on paper. If your income also weakens at the same time, you are poorer in real life. But the bank still wants the same monthly payment on the same date in the same amount. Pause for a second and really think about that. The world around you is adjusting downward, but your obligations are frozen in place. That means debt becomes heavier over time, not because the interest rate changed, but because everything else did. This is why falling prices are not automatically good news. Yes, a cheaper television might sound nice, a discounted car might look attractive, but when businesses are earning less, they respond in predictable ways. They cut hiring, they freeze wages, they reduce hours, they delay expansion. Some fail entirely. So even though certain goods become cheaper, the ability to earn the money needed to buy them gets weaker. And then the psychology shifts. Households stop spending because they expect prices to fall further. Businesses stop investing because demand is fading. Banks become more cautious because collateral is weakening. Borrowers stop taking risks because they're already overextended. Everyone retreats at once. Everyone tries to repair their own balance sheet. And when millions of people do that together, the economy starts to contract inward. That's what a balance sheet recession really is. It's not just a recession with bad headlines. It's a period where private actors become obsessed with paying down debt, preserving cash, and avoiding loss. Growth slows, not because people forgot how to produce, but because their old debts are now suffocating their present decisions. And this is the brutal irony of deflation. The more responsible people try to become, the weaker the system gets. They save more, spend less, avoid leverage. Individually, that seems rational. Collectively, it deepens the slowdown. So deflation is not the mirror image of inflation in some neat symmetrical way. It's more claustrophobic than that. Inflation erodes slowly. Deflation traps. It locks households into yesterday's obligations, while today's income shrinks and tomorrow's prospects fade. And once enough families are caught in that squeeze, you no longer have a temporary downturn. You have a society that stops moving.
If you want to see what this looks like when it plays out over decades, you don't have to imagine it. You can study what happened during the Japan lost decades. At the end of the 1980s, Japan looked unstoppable. Asset prices, especially real estate, had reached extreme levels. There was a widespread belief that land, particularly in major cities, would only go up. Sound familiar? Corporations borrowed aggressively, households followed, and the entire system leaned into the assumption that growth would continue. Then the bubble burst. Property prices didn't just dip, they collapsed. Equity markets followed. And instead of bouncing back quickly, the economy entered a prolonged period of stagnation. Prices drifted downward or stayed flat, growth slowed, confidence evaporated. But here's the part that matters. The debt didn't disappear. Companies were still carrying loans based on inflated asset values. Households were still tied to mortgages taken out at the peak. Banks were stuck with balance sheets filled with assets that were no longer worth what they once were. So instead of expanding, everyone started repairing. Businesses stopped investing and focused on paying down debt. Banks became cautious, limiting new lending. Households tightened spending, prioritizing savings over consumption. On the surface, it looked responsible, but across the entire economy, it created a kind of paralysis. And this is where the generational impact begins. Young people entering the workforce during this period faced a completely different reality than the generation before them. The old expectation was simple: graduate, find stable employment, climb steadily. But the system no longer supported that path. Full-time positions became harder to secure. Companies preferred temporary or contract workers, flexible, lower risk, easier to cut. A new category of worker emerged in Japan, often referred to as freeders, young people cycling through part-time jobs, unable to break into stable careers. Think about what that does over time. If your early working years are unstable, your income trajectory never fully recovers. You delay major life decisions, buying a home, starting a family, building long-term security. And because income is lower, savings are lower, investment is lower, everything compounds in the wrong direction. Now layer debt on top of that. Even if you personally avoided large loans, the system around you is still weighed down by them. Companies are cautious, wages are stagnant, opportunities are limited. The entire economy moves slower because it's still dealing with the excesses of the past. And this is the key insight. Deflation doesn't just affect prices, it reshapes behavior. People become more conservative, more risk-averse, less willing to borrow, invest, or expand, which sounds rational, but at scale, it locks the system into low growth. Japan didn't collapse, that's important. There was no dramatic failure, no sudden breakdown. Life continued, infrastructure worked, society functioned. But something changed beneath the surface. Momentum disappeared. For decades. And for the generation that came of age during that period, the impact was permanent. Lower lifetime earnings, fewer opportunities, a constant sense that the system no longer rewarded effort in the same way it once did. Not because they failed, but because they entered at the wrong time. And this is what makes deflation so difficult to detect early. It doesn't feel like a crisis at first. There's no single moment where everything breaks. Instead, it's a slow adjustment, a shift in expectations, a tightening of conditions, a quiet reduction in opportunity. Until one day you look back and realize that an entire decade, or two, has passed without real progress. And if you connect that back to the couple in the house from earlier, the picture becomes clearer. They're not just dealing with a bad year. They might be stepping into a system that doesn't recover the way they expect. A system where prices don't rebound quickly, where wages don't catch up, where debt stays fixed while everything else softens. And if that happens, the trap doesn't close all at once. It tightens slowly, year after year.
If you want to see deflation in its most unforgiving form, you don't start with modern housing markets. You go somewhere simpler. Somewhere where the math is impossible to hide. You go to agriculture. Look at what happened during the Great Depression. Before the collapse, farmers were doing exactly what rational people are supposed to do in a booming economy. Crop prices were high, demand was strong, land values were rising steadily. From the outside, it looked like stability, maybe even prosperity. So they expanded. They bought more land, invested in better equipment, increased production. And like most expansions, it was financed with debt. Banks were willing to lend because the numbers made sense. If you can sell wheat at a high price, you can service a larger loan. If land keeps appreciating, it becomes solid collateral. Everything reinforced the same belief: growth would continue. And this is important. These weren't reckless decisions. They were logical decisions based on the reality at the time. Then the system shifted. Demand dropped.
prices collapsed. Not gradually, but hard enough to break assumptions. Wheat that once sold at one price suddenly sold for a fraction of it. Cotton, corn, livestock, everything moved in the same direction. The farmer was still producing the same output, sometimes even more, but the market no longer rewarded it the same way. And that's where the trap closed. Because the debt didn't move. The loan agreements didn't care about market conditions. The payment schedule didn't adjust to falling prices. The farmer still owed the same amount of money on the same timeline under the same terms. Now pause for a second and really follow the math. If your revenue drops by 50%, but your debt stays fixed, your burden doesn't just increase, it explodes in relative terms. What used to be a manageable payment becomes suffocating. What used to take a portion of your income now consumes most of it. And it gets worse. Because in a deflationary environment, money itself becomes more valuable. Each dollar is harder to earn. So the debt you owe isn't just fixed, it becomes heavier in real terms. You're paying back yesterday's loans with today's more expensive money. This is where many farmers broke. Not immediately, not all at once, but gradually as the pressure built. They cut costs, worked longer hours, tried to hold on, but the numbers kept moving against them. Eventually, payments were missed. Then came the banks. Foreclosures spread. Land was seized, equipment repossessed. Families that had operated for generations were pushed out, not because they stopped producing, not because they became incompetent, but because the structure around them changed faster than they could adapt. And here's the part most people miss. In some cases, the real burden of their debt didn't just double, it effectively tripled. Not because interest rates spiked, but because the price of what they were selling collapsed while the nominal debt stayed exactly the same. So they were running on a treadmill that kept speeding up while their legs were getting weaker. Now bring that back to the present. A homeowner taking on a large mortgage during a boom is not that different from a farmer expanding during high crop prices. Both are responding to signals. Both are acting rationally within the system they're in. Both are assuming that the future will look somewhat like the present. But deflation breaks that assumption. If property prices fall, the asset loses value. If wages stagnate or decline, income weakens. But the mortgage, the obligation, remains fixed. Month after month, year after year. And just like the farmer, you don't fail because you stopped contributing. You fail because the math stops working. That's what makes deflation so dangerous. It doesn't require bad decisions. It doesn't require speculation or excess in the way people usually imagine. All it takes is leverage and a shift in conditions. Because leverage amplifies everything. On the way up, it accelerates gains. It makes growth feel easier, faster, more accessible. But on the way down, it does the opposite. It locks you in. It removes flexibility. It forces you to meet obligations that were designed for a completely different environment. And once that flexibility is gone, survival becomes a question of endurance. How long can you hold on while the numbers move against you? For many farmers in the 1930s, the answer was clear. They couldn't. Not because they lacked skill, not because they lacked discipline, but because in a deflationary system, the burden of debt doesn't just stay the same. It tightens until something breaks.
Once you understand how deflation works, the outcome becomes uncomfortable, but very clear. This isn't a system where everyone suffers equally. There are winners, and there are losers. Start with the losers, because that's where most people unknowingly sit. If you're carrying debt, you're exposed. Mortgages, business loans, personal credit, it doesn't matter. In a deflationary environment, those obligations become heavier over time, not because the terms change, but because everything else does. Your income weakens, opportunities shrink, cash becomes harder to earn, and yet the number you owe stays fixed. So each payment takes more from you than it did before. What used to feel manageable becomes restrictive. What used to be a plan becomes a burden. And because deflation tends to last, not months, but years, this pressure compounds. Then there are businesses with leverage. Companies that expanded during growth suddenly find themselves overextended. Revenue declines, but debt service remains. Margins compress. Layoffs follow. Investment stops. Some survive by cutting deeply. Others don't survive at all. And behind that, there's a broader category. Anyone dependent on rising prices.
Real estate investors, asset-heavy portfolios, growth assumptions built into long-term plans. When prices stop rising, or worse, start falling, the entire model breaks down. Now flip to the other side, the winners. And this is where deflation inverts everything most people believe about money. Cash becomes powerful. Not exciting, not glamorous, but powerful. Because as prices fall, the purchasing power of cash increases. The same amount of money can buy more over time. And more importantly, cash carries no obligation, no payment schedule, no interest ticking in the background. It just waits. And in a deflationary system, waiting is a strategy. Then there are the debt-free. People who don't owe anything, no mortgage, no significant liabilities, are in a completely different position. Their income might still be affected, but they're not being squeezed from both sides. They have flexibility. They can adjust. They can take advantage of lower prices instead of being crushed by fixed obligations. And finally, liquidity providers. Those who have cash or access to capital during a downturn often end up acquiring assets at distressed prices. When others are forced to sell because they have to meet obligations, the liquid buyer has the advantage. Pause for a second, because this is the inversion. In inflation, debt can be an advantage. Assets rise, money becomes cheaper. Leverage works in your favor. In deflation, that flips. Debt becomes a weight, cash becomes optionality. Flexibility becomes survival. And the people who navigate it best aren't necessarily the smartest or the most aggressive. They're the least constrained. Because in a system that is contracting, the real advantage isn't growth. It's the ability to move when others can't.
So what do you actually do with this? Not panic, not assume deflation is guaranteed, and not try to predict the exact timing of something that by nature unfolds slowly and unevenly. This is about positioning. Because if deflation is the environment where debt becomes the trap, then the response is straightforward. Reduce the trap. Start with leverage. Look at any variable rate debt first. That's the most sensitive layer. In unstable environments, rates can move unpredictably, and income isn't guaranteed to keep up. Reducing or eliminating that exposure creates immediate breathing room. Then move to total debt load. This doesn't mean you need to eliminate everything overnight. That's not realistic. But shifting your mindset helps. Instead of maximizing borrowing capacity, start prioritizing flexibility. Every unit of debt you remove is one less fixed obligation pulling on your future income. Next, build liquidity. Not for returns, not for optimization, for optionality. A cash buffer gives you time. It allows you to absorb shocks without being forced into bad decisions, selling assets at the wrong time, taking on worse debt, or locking into unfavorable terms. And this is important. Resist the urge to overextend during good periods. Because deflationary traps are set during expansions, when credit is easy, when optimism is high, when the system quietly encourages you to take on more than you should. That's when the foundation is laid. So the protocol is simple, but not easy. Less leverage, more flexibility, enough liquidity to withstand contraction. Because in the end, the house wasn't the problem. The market wasn't the problem. Even the timing wasn't the real issue. The trap was the fixed obligation in a world that refused to stay fixed. And once you understand that, the goal changes. You stop trying to maximize upside and start making sure you're still standing when the cycle turns.